Hey Bowtie Nation, Joseph Hogue here with one of our favorite dividend ETFs here on the channel, the Schwab Dividend Equity ETF. Only this isn't the same SCHD you know. This one is better. Against the 3.47% dividend for the SCHD, this one pays you 5.3%. Stocks in this new SCHD have grown their revenue by 8.1% over the last year, much faster than the 0.2% revenue growth on the SCHD you might know. Stocks in this new SCHD also have lower payout ratios and lower PE ratios, meaning cheaper stocks and more sustainable dividends. But how have I found this bizarro, evil twin version of the SCHD? I created it, a Frankenstein's monster dividend ETF.
It's alive!
I dissected the 99 stocks in the Schwab Dividend ETF, dug into the research for each and every company. I found the dividend yield, growth in earnings and revenue, the payout ratio, and the PE ratio for each, along with the company's operating profitability. And what I found is there are pieces of the SCHD holding the dividend fund back. Stocks in the fund that are keeping you from collecting the highest dividend you can collect, and companies that are overvalued and underperforming. Companies like Leggett & Platt with its dividend of just 1.6% a year, hardly even a dividend stock, and Pfizer, which has seen its earnings plunge by 98% over the last year. How long do you think it can keep paying that dividend with earnings crashing? Against the 3.5% average dividend, there are 17 stocks in the SCHD with a yield under 2.5%, holding the rest back and robbing you of yield. So like any good stock nerd turned mad scientist, I'm picking out the best 15 stocks in the SCHD to make a fund with a monster yield. This isn't going to be just the highest dividend possible though. I picked apart the fundamentals for each stock to pick the 15 best investments with the strongest growth, the most sustainable dividend, and the best value. Dr. Frankenstein would be proud. Before we get started though, you know I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. First, let's dig into the Schwab Dividend ETF, the SCHD you know. All you out there in the nation know this has been one of our favorite dividend funds for a long time. The fund is designed to invest in the 100 U.S. high-yielding dividend stocks with a record of consistent payments. And that sounds great, but like a lot of ETFs, the actual stock picks tend to shift from that goal. So looking deeper into the fund, you start to question some of those stocks, especially on that high yield objective. And while that 3.5% yield isn't anything to get worked up over, the fund does make up for it in safety and total return. For example, when the high-flying tech stocks of the NASDAQ 100 fell 30% on those higher interest rates in 2022, the SCHD fell just 10%. And total return has also been something that put this fund on our radar. Against other high-yield ETFs, you're actually earning a much higher total return with the SCHD. For example, the QYLD ETF and then monthly dividend stock AG&C are supremely popular with yields of 12% and higher, drawing investors in for that cash flow, but have produced total returns that have lost your money over the last 5 years. While the 3.5% cash yield you get on the SCHD makes it harder to pay those bills from your dividends, it makes up for it with an annualized return of 12% over the last 5 years. And then looking at these individual stocks in the fund, it's easy to see why it does so well. These are all blue-chip, bellwether companies leading their industries. By fund definition, they are some of the most dependable dividend payers in the market from companies with stable and reliable cash flows. Companies like Home Depot, Chevron, Pepsi, and Coca-Cola. But then besides the dividend yield, I know we can beat. Other fundamentals for the companies in the ETF do worry me, lead me to believe that you're not getting all that you could and that dividend isn't going to grow like it should. That's because companies in the SCHD have seen their profits stagnate over the last year, zero growth in the year for the most recent quarter, and revenue growth hasn't been much better, only growing 0.2% over the last year on average. Now, a company not growing its sales isn't going to be growing its revenues, and flatlining earnings means dividends are going nowhere. The payout ratio for many of these companies, how much of the company's earnings are earmarked to pay those dividends, are getting dangerously high. Over the entire list, companies are paying out nearly 65% of their profits just to satisfy that dividend. That is 2/3 of the earnings paid out. How much is left for growth, and if earnings do fall, is that dividend going to be safe? And while the PE ratio for stocks in the SCHD is lower than the market, that 17.5 times on a price-to-earnings basis is quite a bit cheaper than the 26 times investors are paying for stocks in the S&P 500 market index right now. But then again, I want a better deal. We can do better. Dissecting the 99 stocks in the SCHD, we find 17 of them with dividend yields under 2.5%, A yield so low it doesn't even qualify as a dividend in my book. We also find 56 stocks with negative earnings growth, more than half of the companies in the fund with falling profits. Now, I don't know about you folks, but I don't invest to put my hard-earned money into companies that are gonna lose it. We've also got 14 companies with dangerously high payout ratios, paying out more than 90% of their earnings and holding nothing back. Companies like Pfizer that lost 46 cents a share over the last year and is now struggling to pay its $1.66 per share dividend. Companies like these, with almost all of their profits needed to pay the dividend, at best aren't going to be growing the payout and could be on the edge of a dividend cut. So yeah, as great as the SCHD is, we can do better. With just 15 stocks from the ETF, the best of the best in the fund, I've created a group that will pay you a 5.3% dividend yield, more than a 50% bump from the SCHD fund. Stocks in this group are growing their revenue at an 8% annual pace, and these 15 companies are converting that revenue into higher earnings growth, growing profits by 33% a year instead of the zero growth in the SCHD fund. This lower payout ratio also means that these 15 stocks are going to be able to grow their dividends, or at least sustain them without danger of a cut. And the PE ratio of just 11.9 means you're getting a steal compared to the average PE of 17.5 on the stocks in the SCHD. You're paying just $11.90 for every dollar generated in earnings for these 15 stocks, 47% cheaper than the $17.50 you have to pay for every dollar of profit in that broader SCHD stock group. I'll show you that entire list of 15 stocks that beat the SCHD next, but there has been a lot of talk about this dividend ETF from its stock split earlier this month. Now, all this aside, I still like the SCHD, but I highlighted in this video why I'm not buying any more on the split. In fact, I revealed 3 stock splits I'm buying instead, so make sure you check that out. Here's that list of 15 dividend stocks, my Frankenstein's monster SCHD ETF. And believe me, it was tough filtering it down to just 15 companies, because again, most of those in the SCHD are bellwether stocks. Here, I wanted to focus on a higher dividend yield, but also the earnings and the revenue growth that would keep that dividend growing. We've got some much higher yields here with Altria Group, ticker MO, Whirlpool, ticker WHR, Artisan Partners, and Guess. In all, a third of the group, 5 stocks, provide cash yields over 6%, which helps boost that average. Beyond that yield boost, it's really about earnings and revenue numbers that make this one stand out from that broader SCHD ETF. Again, the fact that the 99 stocks in the SCHD are reporting zero growth in revenue and earnings worries me for the dividends in that fund. Here, though, we've got an 8% revenue growth and a very solid 33% earnings growth that should help these 15 stocks continue to grow their dividend payments. Now, I wasn't able to get the payout ratio as low as I wanted, or to find companies with higher operating margins, but I was really happy how this price-to-earnings valuation came out, much lower than with the overall ETF. On a sector level, we don't quite get the diversification across the economy as in that SCHD. Obviously, with just 15 stocks, there weren't great picks from each sector. My monster SCHD is heavy in the financials with 5 of the 15 stocks, but then the original SCHD is heavy there as well because it's the sector with the highest and most dependable dividends. We're also heavy in the consumer discretionary stocks here with 4 of the 15 companies, while only 10 of the original SCHD are from that sector. But here we still do have a good mix of 4 other sectors and enough diversification to make it a safety fund. Now, of course, one downside of this group is you're going to have to manage this yourself. Rather than just buying shares in that SCHD to get all 99 stocks in the fund, you do have to buy the 15 stocks individually. Those stocks in the SCHD Dividend Fund don't change frequently, so I'm not worried about it drifting away from the fund, but it's still more work to buy them initially. On the upside, though, buying the individual stocks this way is going to save you that 0.06% management expense fee charged just to hold the SCHD fund each year. It doesn't sound like much, but why pay it if you don't have to? And you can get higher dividends and better stocks on your own. Stay up to date with all the stock market news, trends, and strategies you need with the Weekly Bowtie, our free newsletter with the invite link in the description below. Or click on the video to the right to see the 3 stock splits I'm buying instead of the SCHD. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.